Welcome to The Explainer. For years, silver was kind of a sleepy market, held in check by a simple story. Central banks had everything under control. But in December of 2025, that story didn't just get an update, it was completely shattered. Today, we're digging into what many are calling silver's great escape.
So here's the game plan. First, we're going to look at that old story, the narrative that kept a lid on silver's price. Then we'll get into the two massive forces that just blew it all up, a shocking pivot from the Federal Reserve and a critical shortage of the physical metal. And finally, we'll ask, what's next? What could this new era for silver actually look like? All right, so for the longest time, the market was running on this one single idea, that central banks would, eventually, get things back to normal, that they'd step back and let the economy fly on its own. And that belief, it kept a really firm lid on hard assets like silver.
But then, December 2025 happened, and it forced this kind of stunning realization, not through what anyone said, but through what they did. The Fed basically admitted, without saying a word, that the system needs permanent life support. And that single idea, well, it changed everything. It was like a light switch flipped for the entire precious metals market. Okay, let's get into catalyst number one. A massive, sudden U-turn from the Federal Reserve. The market saw this as a flashing red light, and honestly, the speed at which it happened was just breathtaking.
I mean, you have to appreciate just how fast this all went down. On December 1st, they stopped tightening. Just 9 days later, boom, they cut rates for the third time. And then get this, 2 days after that, they're announcing a whole new bond buying program. We're talking less than 2 weeks to go from tightening to full-on aggressive easing. That kind of whiplash just screams one thing to the market. They were deeply, deeply concerned about something.
So what did this monetary rocket fuel actually look like? Well, it was a classic 1-2 punch. First, you had the rate cuts, and this being the third cut of the year, it showed a huge change in their priorities. They weren't fighting inflation anymore, they were trying to stop a crash. And second, they rolled out this new purchase program, and the scale of it was just staggering.
$40 billion a month. Just let that sink in for a second. That's nearly $500 billion a year in new money being created out of thin air to buy up government debt. It's a fire hose of liquidity aimed right at the heart of the financial system, right after they told us they were done with all that.
And of course, you had the Fed out there trying to spin it, right? They were very careful to call it a technical intervention, anything but quantitative easing. But look, the market's not dumb. It doesn't care what you call it. When you print money to buy debt, the effect is the same. The market immediately called their bluff and labeled it what it was, QE5.
So what's the bottom line here? What does this all really mean? Well, this combination of falling interest rates and creating new money is a direct assault on the value of the dollar. It creates this perfect storm where the money in your bank account is actually losing purchasing power over time. And that forces big money and small money to look for a lifeboat, to find a refuge in something real.
Now look, if this was just a money printing story, it'd be compelling enough, but it's not. That's only half the picture. All that monetary rocket fuel was poured onto a fire that was already raging, a deep structural deficit in the actual physical silver market. This is the other half of the equation, and it's what makes this whole situation so explosive.
And this isn't some new thing. For 5 years running, the world has consumed more physical silver than all the miners on the planet could pull out of the ground. We're not talking about a tiny gap either. In 2025 alone, that shortfall was over 200 million ounces. That's a structural problem, and it means global stockpiles have been getting drained year after year.
So why is this deficit so stubborn? This chart tells you everything you need to know. A whopping 60% of all silver demand is industrial. See, unlike gold, which mostly sits in vaults, industrial silver gets used up. It's built into products, and it's gone forever. This demand isn't optional. It's the bedrock of the entire market.
And we're not talking about small stuff here. We are talking about the absolute backbone of our modern world. Solar panels, electric cars, the smartphone in your pocket, 5G infrastructure, all of it has to have silver. Why? Because it has conductivity that is simply unmatched. There is no viable substitute. So for these huge tech companies, the price of silver is almost an afterthought. They need it, no matter what. That's what you call price inelastic demand.
So, you've got the gasoline of money printing on one side. You've got the raging fire of physical scarcity on the other. What happens when those two things finally collide? Well, the reaction was anything but subtle. It was the moment of ignition.
the market's reaction was immediate. The Fed's pivot sent the dollar plunging, and all that capital went looking for a safe place to hide. It flooded into silver. This triggered a massive technical breakout, shattering a price ceiling that had held for more than a decade. It was like a dam breaking, signaling the long arrow suppression was finally over.
And what threw even more fuel on that fire? A classic short squeeze. For years, big institutional players had been betting against silver. As the price ripped higher, those investors were forced to become buyers at any price, just to cover their bad bets and stop the bleeding. That forced buying creates a vicious feedback loop, pushing the price up even faster.
But honestly, the most important result here was a complete psychological shift. The old script was torn up. The Fed's sudden pivot was a loud and clear admission of systemic weakness. And in that moment, silver transformed from just being an industrial commodity into an absolutely essential monetary hedge, a lifeboat in a currency storm.
So where does this all lead? This doesn't feel like just a short-term trade. The events of December 2025 might have kicked off a fundamentally new era for hard assets. So let's try to project what the path forward could look like, now that silver seems to be breaking free.
The simple math of the gold-to-silver ratio is pretty compelling. It just tells you how many ounces of silver it takes to buy 1 ounce of gold. A ratio of 67-to-1 is historically very, very high, meaning silver is cheap compared to gold. If that ratio just returns to its historical average, we're talking about a significant move up. And if it revisits the kind of levels we've seen in past bull markets, well, the math implies a silver price well into the triple digits.
And it's so important to remember this isn't just about paper contracts on a screen. This entire move is supported by a real, tangible shortage of the physical metal. Those 5 straight years of draining inventories provide an incredibly solid floor under this market. This breakout has real substance.
Ultimately, it really comes down to this. For years, people who own precious metals were told they were crazy, that they were fighting the all-powerful Fed. But in a strange twist, with its actions in December 2025, the Federal Reserve itself basically validated their entire thesis. The Fed has admitted its only tool left is the printing press, and that has lit the fuse on a global search for something real.
Which leaves us with this one final question. On one side, you have an unprecedented wave of monetary demand, born out of a central bank's desperation. On the other, you have a physical market that has been starved of supply for half a decade. What happens when those two unstoppable forces finally collide head-on? We are all just beginning to find out.